Well, let's move on now and head back to Kenya, where the Monetary Policy Committee has decided to retain its policy rate, the CBR, at 9% in its meeting today. Now, inflation in the East African economy has been steady for most of the year, but the MPC expects it to rise gradually, citing the imposition of the 8% VAT on petroleum products, as well as a rise in international oil prices. Well, Kenyan legislators did not remove caps on interest rates in the 2018 Finance Act, and lending to the private sector has remained subdued. Well, earlier I spoke to Jibran Qureishi. He is the economist in charge of East Africa at Standard Bank, and I started by asking him for his assessment of the latest rate decision.
It was probably because, the governor themselves have admitted in the past that in an environment where rates are capped, when they were cutting rates previously, as it did in the past couple of meetings, it was probably prudent for them to, take a step back and, try and assess whether there would be a perverse reaction. So I think that was something that was central in the decision today. But in addition to that, what we saw in the statement is a hint of concern, if you like, that there could be some second-round effects from the VAT on fuel. So I think a combination of those two things have probably prompted the committee to stand steady. And the other interesting thing is that, unlike the previous couple of statements, the phrase where the committee said there's room for an accommodative policy stance has also been, removed from that statement.
Well, let's touch on inflation. We did see inflation drop slightly to 4% in August. The CBK says it does expect it to rise. In fact, it said inflation expectations remain anchored within the target range due to lower food prices. To what extent do you see this new finance bill impacting inflation going forward, especially that 8% VAT on fuel?
I think the bill in itself is very inflationary. If you think about, everything from the 8% VAT, the tax on confectionery products, other excise, duties that have come through. Generally, there will be a transmission that will lead to higher output prices. Of course, many in the economy and anyone who analyzes inflation will tell you that if we did have the 16% VAT, then not only would we have got closer to 6.5% or 6% in this month's inflation print, but we would potentially get closer to about 7.5% or 8% by the end of the year. I think now it's slightly different. We'll probably not get to 6% as quickly as I expected, not this month. But by the end of the year, I suspect we'll be closer to 7%. Even with an 8% VAT, what you have to remember is that there will be a ripple effect on other sectors, transport, logistics. And at the beginning of the month, if anybody increased prices because of the 16% VAT initially, that's going to remain sticky. They're not going to very swiftly reverse prices because of the 8% VAT. So I think prices in that regard will be sticky. But inflation for now will be rising. The only question is, will the central bank view this as transitory, or will they believe that there's some urgency to actually take some policy action in the next couple of months?
What about those rate caps? Kenyan legislators, they chose not to repeal them entirely. How will that affect private sector growth going forward, and of course investment decisions as it trickles down the line?
It was disappointing that lawmakers never saw, never thought it was important to actually revise the rate cap and decided to remove the floor. To me, that was an underwhelming decision, an underwhelming revision. What we have noticed is that commercial banks have generally realigned their business models to operate in this very difficult environment. And some of the things they have done is, shift away from the expensive time deposits towards current accounts, and they've reduced overheads. But of course, lawmakers look at that differently, and they look at banks still making money. But banks are not making money through financial intermediation or through loan growth, and that's how banks should make money to have a positive impact on society or on social welfare in the country.
Well, we did see legislators remove the mandatory limit on savings, on the savings rate. So was that meaningless, essentially? What are your thoughts?
I wouldn't say it's meaningless. I just don't think it's a silver bullet. I don't think it's going to be it's going to be the remedy to cure the sluggishness in private sector credit growth.